Welcome to the stream, ladies and gentlemen. I promised and I delivered. Happy 4th of July. First and foremost, hope everybody that wants to is getting a chance to see some fireworks tonight. Or perhaps in some places they've already done fireworks. I think I accidentally caught glimpses of two different fireworks shows out here in the Phoenix metro area. I hope everybody's having a safe 4th of July. Nobody's blowing off any fingers by mishandling explosives on this day, by mixing explosives and alcohol, as is so often the case. Hope nobody's getting any tickets for illegally lighting off fireworks within city limits, anywhere, etc., etc. Today, I want to talk about some tools that you can use to help you achieve your version of financial freedom, whatever that happens to be. Some free, some not, but they're just tools for your tool belt, essentially. So one of the first things, and you've been seeing this in more and more of my videos lately, is stockanalysis.com. And this is linked in the description. So you can go ahead and take a peek. I mainly use, now they have stock screeners, which, you can get stock screeners in multiple places. They've got one. Yahoo Finance also has one. Now, the free screeners you won't necessarily be able to screen for every single thing that exists, but generally speaking, you can filter for a lot of the basic financial metrics you might be looking at anyway. It's a good way to kind of separate some of the wheat from the chaff, get rid of the 95% of stocks that are just hot garbage that you wouldn't want to be interested in anyway, and narrow down your field of vision to just the stocks that might be warranting a closer look. As you can see, they've got everything from the PE to the price to sales, price to free cash flow. They've got down to the sector, the industry. Now, they also have dividend yield if you're really focused on dividend, buyback versus dilution. So you've got all these options for things you can filter for, and Yahoo Finance is a pretty comparable thing if you prefer their screener instead. Doesn't really matter. You can screen stocks for free, okay? And I really recommend everyone do it rather than just taking shots in the dark and saying, hey, I'm going to just look into this company just because I've heard of it. That's not really that great of a starting point. We've all heard of hundreds, if not thousands, of different companies out there, and it's not really feasible to try to do a deep dive on every single one without filtering for some kind of basic criteria beforehand, okay? But the main thing I like this site for, if you saw my recent thing on Apple, is you can get a really quick overview of 10 years of their historical financials. So you can go back further if you get a paid account, which is often the case for a lot of these free tools. They'll open up more historicals, more analyst-based stuff. There you go. Somebody in the chat shouting out FinViz. Right, there's a ton of these kind of tools out there. Now, I personally like stock analysis because, one, it's pretty simple, easy to look at, and I think it translates well to the screen also. Because I screen share for the videos and the live streams and such, and so that's a kind of a factor for me. But if you're curious what I use and why, well, there you go. Now, one thing I like to caution people about, though, on these data feeds is that they're fed by usually something like Morningstar, who aggregates all the data from all the financial statements and stuff that are released every time a company does a filing, and sometimes it transfers over and isn't quite right. And the place where I notice you see the most errors generally is like the balance sheet. It often has trouble distinguishing different categories of specific types of liabilities and things like that. So when it comes to looking over balance sheets, unless it's just like a very, very basic type thing where you're only interested in seeing the total assets, total liabilities, and total shareholders' equity, I wouldn't lock in your view of any specific line item in the data feed. I would actually pull up the company's actual financial statements and look at their most recent balance sheet. It's worth doing that. Okay, I mean, it's worth doing that in the first place if you've already had something pass your screener and you decide that it's close enough that it's worth a closer look. But I like these kind of free things more for the historicals, because you can get an idea for, what their kind of annual growth rate is on things like their revenue, their EPS, how consistent they are with buybacks and stuff like that at a glance. It's a little harder to do that, like going further and back, pulling up individual PDFs for each year or each quarter. So that's where you can kind of get your time saving and your value on something like this. So another thing you guys have seen me implement a little bit more frequently is this discounted free cash flow calculator on GuruFocus. Now, there's tons of DCF models out there. You could even do one in an Excel sheet or something like that. But this thing is convenient because it is hooked into a data feed, much like stockanalysis.com. And so there are some 10-year historical numbers available on here, which if you're just looking at like a zoomed out view to get like a basically cursory idea of what kind of realm of reality you're in for a stock's valuation, you can kind of at a glance come up with some provisional numbers, right? You're not going to base everything off of any one of these tools. It's just, hey, you're getting kind of an idea of what a good starting point is. And then you would want to add to some kind of a watch list, right? Now, you can watch lists almost anywhere. I think pretty much all the brokerages, the modern ones, probably have some form of watch list. Personally, that's one of the reasons I have a Robinhood account, is I like their watch list. You can basically set pretty much any number of companies that you want on the watch list, set a price target where it will literally, like if the price target you set is above the current price, it'll alert you if the stock goes over that price. If it's a lower price, which if you're waiting for a stock to come down to the buy zone for, for your target price, you can get an alert when the stock falls below that price. And then you have that opportunity to then be like, oh, there's my reminder to look at it. It'll do, I think you can set it to do notification directly onto your phone, like a push notification, as well as possibly an email. Now, another reason that I have a Robinhood account is because they're one of the more accessible brokerages for a lot of different things. Now, I like the watch list. I also have a little bit of money in there. Have some shares of some things, and I used Robinhood actually to learn options. Basically, if you're trying to figure out what options even are and how they work, I think the user interface with Robinhood is pretty good. Also, interesting point when it comes to the whole idea of being, we'll call it, free to dictate your own financial destiny. Something like margin at a lower interest rate than what you can get kind of out there. 7.75% if you're a gold member. Gold member, like Austin Powers, right? So that's not the lowest. but it is not it's not terrible if, for example, you have, like, let's say you've got like a few $1,000s in stocks on Robinhood. You need a little bit of liquidity for something in your personal life. You could do worse than 7.75% without any kind of hard pull on your credit report or anything like that. Sort of being your own bank in a sense, right? I haven't had a chance to really look into CTSH yet. Maybe we'll get to it later in the stream because it seems to always turn into me pulling up different stocks. But shout out to you there for joining in. So, M1 has actually lower interest on their margarine. I said margarine on purpose, by the way. So, oh gosh, where was it? Oh yeah, 6.95%. So they're a little bit lower, but their premium service is more expensive. And M1 does not have options. Now, M1 is more geared towards strict, like, buy and hold, hands-off type investing, build your own ETF type stuff. Now, I've been using it for our YouTube thing because I think that's really better for like visualizing our YouTube portfolio. So that's why I use it there. And also, if we build it up big enough, I did go ahead and go with M1 Plus. Down the line, again, if you need a margin loan from them, no credit checks. And honestly, if you watch like Caleb Hammer or something and you see what people take out as far as interest rates on their car loans and their personal loans and stuff, a lot of them are getting loans a lot higher than 6.95%. And if you've got yourself a really, a decent, respectable size, dividend stock portfolio with a lot of consumer staples, or even utilities and things like that in there that are really stable, defensive, don't really fluctuate a lot in price, pay out a consistent yield, your stocks can basically pay your interest for you, in a sense, right? Again, this is being your own bank, giving yourself a loan without a hit on your credit. It's an interesting proposition. Now, I'm investigating if there are any better deals out there than M1. I suspect it may be possible to get a better deal on something like maybe Interactive Brokers, but have not opened an account there yet to actually really dig into it. Now, think about it like this. If you have a need, right? I'm actually thinking about getting further and further away from using regular banks for basically anything and getting more and more of my cash into brokerages and into securities and keeping the bare minimum amount of actual liquid cash, because a lot of these brokerages, they offer a reasonable amount of liquidity with an interest rate that's not bad, like compared with personal loans, credit cards, etc., that are out there in a lot of cases right now. And so it's like, hey, if something comes up, some kind of major expense, suddenly need to, do a major automobile repair or something else, lean a little bit on the stocks. It's, I don't have a home, so home equity loan's not really an option. It's an idea that I had. Some may say that that's a little risky, but I mean, M1 only lets you take 40% of the value. So if you're in mostly stable, low-risk defensive stuff, I don't see how that's really that bad of a risk. At least not for me. So yeah, that's an idea I'm toying around with. Banks are just, you ever hear people refer to bankers as the banksters? Oh, hey Roberto, happy 4th. I don't have a beer, but I've got this now empty can of Dr. Pepper Zero Strawberry. All right, so that kind of goes over some of the possible tools you can use to give yourself a little bit more freedom, flexibility, what have you, an ability to do research for yourself. Granted, I still want you to watch my stuff, but if you're curious what I use, the links to Stock Analysis and Guru Focus are in the description below. If you're interested in M1, if you were to sign up and deposit $5K into an account, we'd both get $100, win-win. Not bothering linking my Robinhood because they'll give you some worthless stock and me some worthless stock. Not even worth it, but they can be pretty useful in a lot of different ways. And, they are the OG when it comes to not charging commissions to buy stock. The reason that everybody stopped doing commission for stock trades is pretty much because of Robinhood. Robinhood forced that change in the industry. Everybody else realized they were going to lose all their, up and coming business from the younger generation to Robinhood if they didn't get on that same page. So give some credit where it's due. I realize a lot of people are still bitter about the whole GameStop debacle and everything, but build me a bridge and get over it. That was a very rare, possibly one-time event. Not going to hold it against them forever. It did make me pause with regards to opening an account with them, but I ended up doing it later. Found I liked their user interface, and so I kept it around, and I have some fun with it from time to time. I used to feature it a little bit on the channel. So, yeah. It needs no introductions, though everybody's heard of Robinhood. Now, I heard somebody mention CTSH. Now, I've never looked at this stock really before, but they were talking about maybe it's some value. So we'll use some of these tools we just talked about to look over it a little bit. So, we've got a decade of fairly decent revenue growth, so give them credit there. We've got them chipping away at some buybacks. Okay. And we've got a bottom line that's mostly growing. A couple little stutter steps in there, but overall, they've been moving it in the right direction over the long run. Recently, some dividend growth too, which seems to be well covered by both earnings and free cash flow, like that. I don't know what they do exactly, but there's a lot to like in these financials. We can look at some forecasts, and I haven't even looked at what their exact PE or anything is yet. I could do the math, but I think it's low teens, like 14, something like that. Correct me if I'm wrong. Whew, guys, I'm gonna have to start asking for supers to review stocks. All right. Oh, by the way, if you become a member for 99 cents a month, I'll give your requests a much higher priority. Okay, EPS growth. Analysts think, they're a little all over the place, but fewer and fewer analysts as we go out. I'll give them credit for, we'll call it mid to upper single digits average. I think that's fair, and they've proven they can do it from what I was seeing on their growth from before for the last 10 years. Where's my window there? Okay, so CTSH. All right. So if we just assume the previous 10 years are the same as the next, we would be in potentially value territory without even giving them credit for their tangible book value. Why don't we give them credit for their tangible book value? They're not like a bank or anything, so this would just be cherry on top more so than anything else. They've already accrued that value on their balance sheet. I do think maybe 8.1 is a little high on the growth, and something like this, I mean, I want a 12.5% return, but I think something like 7% growth, maybe 7.5, somewhere in that range, a little bit more reasonable. And yeah, I mean, this thing is, assuming I understand what they do, very close to where I would personally be interested on a multiple of earnings basis. Oh wow, the free cash flow is even better. That's amazing. Yeah, no, this thing, I mean, this thing definitely looks pretty good. Yeah, if you do it based on free cash flow, it turns out even better. So yeah, I like it. I like it a lot. EPSN, what do they do? I've never heard of EPSN. Oh, Epsilon, huh? Is this a master limited partnership? Is this an MLP? I feel like it is. Do you get a K1 when you invest in this thing? Epsilon. Yeah, I don't see anything on whether they're an MLP or not. If you're asking for it, you should know. Tell me. Okay, yeah. So if it's an MLP, you get a different tax form called Schedule K1, and it's different on your taxes. And if you get a lot of them, it's a lot of extra forms for your CPA, and they probably will be kind of pissed at you. So just be wary of. I mean, it's not the biggest deal in the world if you have a couple. I mean, your CPA will know how to deal with it, but it is like it's like slightly more work if they charge you per form. You know, like if it's every additional form they charge you more to file your taxes, it may not be worth it, right? So I recommend everybody has a CPA do their taxes, because oftentimes it ends up being cheaper than like an H&R Block situation, and the CPA can give you better like guidance on how to manage your taxes like in the future, depending on what you do and what your situation is. They will know the tax code. The person at H&R Block knows how to move the numbers from your W-2 in the correct box on their software, and that's about it. A lot of people don't realize that, but that's pretty much the case. So, yeah, I would just say, know what you're investing in, what the structure is, what the tax implications are, okay? No, I mean it's not as simple as just avoid. Um, it's just like understand that there's going to be an extra form mailed to you because you're basically considered like like a non-managing partner when you buy into a master limited partnership. You're considered a limited partner, not a shareholder in the way that you are with like a regular business, right? A regular like C corp. So as such, you get a distribution and a partner's distribution for how many units of the partnership you own on a Schedule K1 instead of a dividend on, you know, that'll show up on like a 1099 div that's issued by your brokerage. It's a little different. And I've never bought a publicly traded partnership before. So I've not experienced that personally. I've just read about it. And it seemed like a little bit more headache because there's plenty of non-MLPs, I think, that are possibly good investment opportunities. So I just haven't done it. By the by, are any of you who are watching right now, how many of you follow the YouTube portfolio thing and vote on that? Just out of curiosity. Because this is, Independence Day. It's a very American holiday, and it's a very democratic thing that we do. Okay. I want to do something with that in relation to channel members once I actually get some channel members. Like, maybe something potentially like to up the ante a bit. So, Peachy, I'm actually surprised you've been watching the channel and in the Discord and stuff as much as you have. So, I have an M1 Finance account where literally I let my YouTube viewers just basically suggest and then vote on stocks that I have to buy with my own money. As far as I know, I'm the only one that does it. And granted, like it's only up to $1,000 total right now. I am going to tell you guys, I did deposit another $1,000. So I deposited another 1,000, and like I kind of want to do something with it in relation to members. Maybe like every once in a while do a buy that is based on like celebrating like a milestone of having a certain number of members and then letting only the members vote on it or something to give them like some kind of a special privilege in there or something. I don't know. I'm thinking of ideas. There's just so many different doors that have opened up now. Actually, I still routinely see comments from my literal 10th subscriber, which is pretty cool. He's really determined to get Dow Chemical. So, all right. So Peachy, so I don't really discuss a lot of lower market cap stuff, especially stuff that's like penny stocks on the channel, or really do much with regards to like allowing people to suggest those as buys and such. So if you have a channel, and granted we're small right now, but if your channel gets large enough, right, and you publicly discuss these like kind of micro cap companies, and people on the channel see you putting money into it, there's a chance that if you have like a lot of like really dedicated people that hang on your words and such, if they start to put buying pressure on these sort of lower volume, lower market cap stocks, it can really it can basically look a lot like a pump and dump kind of thing. And there are a lot of channels out there where pretty much all they do is they build up a good little following, and they'll choose some random low volume, low market cap penny stock. They'll buy some amount of it, and then they will talk about it endlessly on their channel, right? And then once the people on their channel have started to buy in and like drive up that price, and the thing is, them doing that, the people on their channel buying it and driving up that price makes it look like that person is right about that stock. So it's like this self-fulfilling prophecy, and then they will dump it basically at the very, very tippy top, and then make a video about how, okay, now's the time to get out because of this, this, and this. And then, well, lo and behold, it crashes down nothing. The problem is a big chunk of their viewers are then left holding the bag, and they're like, well, you should have listened to me. You waited too long to listen to me. And like they kind of spin it so that it's the person's fault, when really, just based on the way like bid ask and stuff like that will work in a lower volume stock, they were basically always guaranteed for them to win and for the lion's share of the people who bought in on their say-so to lose. But like something big like CVS, for example, since we're talking about that, no, there isn't a YouTuber on the internet except for maybe like Mr. Beast or like PewDiePie who has enough followers to move like a large cap, like tens of billions of dollar company with, you know, random buys and sells from their viewers, right? But it doesn't actually take a very big following at all to make a big difference in how a micro cap with low trading volume, you know, it doesn't take much to drive one of those up or down, basically. You add a few hundred excited buyers in on a stock that usually has almost no volume, and it bids up very quickly. Yeah. So, like, it's just, like, I don't even know if it's, like, technically, like, against any kind of regulation or anything, because I'm not anybody. I'm not, like, a analyst. I don't have, like, I don't have any, like, licenses or anything like that, so there may not even technically be any, like, ethical things technically, but it's definitely slimy, and I don't agree with it. I don't like that practice. Sad thing is, though, that it works, right? A lot of people who do that, they have, I mean look at, there's people who do it that have a lot of subscribers, and it's disgusting. Yeah. So, yeah, CVS, if like I was to start from scratch and look at Walgreens and CVS right now, I'd probably go with CVS. Now, in the past, CVS looked too expensive at the time, and I ended up going with Walgreens and already kind of have a full position there. Yeah, I appreciate that, Roberto. I think if you have people who take you seriously. Medical Properties Trust is by far my favorite REIT. In terms of value, right? Because, I mean, all right, I haven't done an MPW video in, like, at least a couple weeks, so I have, if you look at the one stock I cover the most on the channel, it's MPW, because it's been the most exciting of everything I've got. Now, my basis is around $10, and, like, when it was hitting like $7 a share ish, man, you know, like, it's hard when you've got over 1,000 shares. But I mean, people who say like, oh, this is a dead thing. Okay, so one thing I want to point out, REITs have to distribute 90% of their taxable income to shareholders. So they can't really retain earnings in order to grow. So share issuance is normal in REITs and BDCs, okay, for that reason. So I don't look at them unfavorably because of share issuance, because that's just part of how they pay out such a large chunk to their shareholders, right? So now if they do that but can't, grow their revenues an equivalent amount to how much they diluted as like a percentage, then I'd say, well, are they making effective acquisitions, right? Because this is how every time they need to buy a new hospital or whatever, if they weren't able to sell something else to do it or whatever, this is pretty much how they raise money, or they have to take debt. And if the shares are trading at a premium, I would rather them issue more to make an acquisition of a property than to take on debt and have to pay interest or whatever on it, right? I hope that makes sense. But here's the thing. Other than last year, they have had overall, pretty consistently growing revenue, right? And so if the shares are going up, but the rents they're collecting are going up, then, it is kind of what it is. And hey, they could stop, and theoretically, their revenue would still go up because they have a CPI-based rent escalator in their long-term leases. So if the CPI says there was, for example, like 4% inflation, theoretically, they can raise rent on that building by 4% if that's in the lease. So that's another thing I like about them. The other is, and this is the main reason I realized they were undervalued. And I realized they were undervalued when they were like $12 a share. And that was enough for me to start selling puts. The premiums help also, of course, with my basis. But shareholders' equity, and granted, this is the annual number for 2022, so it's not 100% up to date, but it's still pretty close to the amount. $8.6 billion in shareholders' equity, and market cap still $5.71 billion. The difference between those two things is the discount on their net asset value. Okay? So another way of, and I don't do discounted free cash flow to value REITs. That's not why I'm in here. But it's just to show you so we put in 0 free cash flow in the discounted free cash flow calculator and only kept the tangible book value. All right? Which leaves us with just the tangible book value. The tangible book value of MPW is $14.11. Okay? That means this is just the balance sheet. This is not the funds from operations and the dividends and all that. This is just the balance sheet. $14 per share. What is MPW's current share price? $9.54. I realize the disconnect in value at around the $12 level. And this is why I wasn't really breaking a sweat when they were at like $7.50 or whatever, okay? Because it's, and people, some person tried to tell me that their medical properties are no better than malls, and that if they needed to sell something, they'd never be able to because the properties are basically worthless, yada yada, and the balance sheet numbers are basically phony. Well, So if that's the case, how were they able to sell their Australian hospitals for very close to the amount they had them listed for on their balance sheet in terms of value? That kind of evaporates that argument, right? The fact is, like, MPW, the people in charge seem to always be able to make some kind of a deal happen that takes, like, the lemons and turns them into lemonade and makes things somehow go in their favor. And it keeps happening, and people still keep trying to shit on them. And it's like, it seems like the people that are negative on the stock are almost like so desperate to be right that they'll come up with anything possible to like drag them in the mud. And it's almost absurd. Now, yeah, granted, like, something could go so wrong that they couldn't recover and whatever, but like, I sit here and I say their assets are worth more than what the stock is trading for. Plus, they still bring in an awful lot of rent revenue and still pay an awful lot of that rent revenue out to their shareholders for holding on to the shares. And so, like, I sit here saying, like, where's the scenario where I lose having shares in this company? And yeah, that's a good way to get me going, is to bring up MPW. So yeah, CVS, you can, it's hard not to just immediately start buying at these prices, for sure. But then again, like, Walgreens is looking super cheap right now too. It's just, at the same time, like, I've already got a really full position in Walgreens, wasn't really looking to grow it much past where it currently is, and I feel like there's better opportunities potentially in other things. And I also wonder, like, how concentrated do I want to be in retail pharmacies? And so that makes me hesitant to go also into CVS. I'm not a sell on Walgreens because I think most of the things dragging their share price right now are temporary problems for an otherwise solid company. Oh, by the way, there is a fun little custom emoji, by the way, for members, and I think it's really quite nice. I wonder if it'll let me do it. Does it let me? No. Huh. It doesn't let me use my own emojis? That's weird. I'll have to look into that. Yeah, PayPal's good. They are a cash flow machine. The biggest drag on them currently is a slowdown in their growth, but a lot of companies have had a slowdown in their growth recently. And so here's an important lesson. And I covered this in my PayPal video. There was, like, all right, so remember, does everybody remember when PayPal was like $300 a share? Yeah, I mean, actually, about right now is the time I would actually probably consider buying Leaps on PayPal if I was really into that. And I have actually seriously considered it. Not my usual style, but extraordinary times call for extraordinary measures. So PayPal was $300 a share. And I did DCF on it, and I'll do it again. Basically, I sat here and I said, what kind of assumptions would we need to make to justify $300 a share for the next 10 years? growth assumptions for the next 10 years to justify 300 being a good price today. So I think I prefer the EPS number for PayPal. They have sort of some elements of being like a bank, and with banks, the cash flow based calculations can be a little weird because of money coming in for deposits and things like that. I think I just know that the cash flow number maybe not the better one to use. So all right, anyways, and plus it's harder to find forecasts for cash flow than for earnings in a lot of cases. So why don't we see what analysts think this year's EPS will be? Okay, about $5. Okay, and by the way, if anything, it would have been worse if you did this calculation 2 years ago. But I'm doing it with today's, numbers, today's accepted numbers. Okay, so $4.98 is the accepted EPS number for this year for PayPal, according to the analyst projections on that site. And they may be up for revision. Analysts can, by the way, they can revise right up until the day of an earnings release, okay? So take them always with a grain of salt, but we will say, okay, let's say PayPal does achieve this number this year. Okay. Right now on default, we have 20% growth rate for the next 10 years on average. How likely do we think that is for PayPal? For them to grow earnings 20% a year for the next 10 years on average. Does anyone believe the size PayPal is that that's a really likely thing to happen? Considering that the bigger a company is, PayPal's already pretty much everywhere. And the larger they are and the more places they are, the fewer extra, they don't have a lot more customers out there to get that they don't already have. Yes, there may be some new markets they get into as different, they may get into more countries than they're in right now. But this number is not all that realistic in my view. It certainly isn't a conservative number, right? So, and you see with this year's projected EPS, which is higher than the EPS was when it was $300 a share, assuming that massive growth number only gets you, and this is with a 10% discount rate. This is matching the long-term average of the S&P 500. This is not a market-beating return we're trying for here. That only justifies a $178 value. So what were the people smoking when they were paying $300 a share for this? And, just look. So to get a market matching return, if you wanted to pay $300 a share and get a market matching return, you would need 28% over the next 10 years. Now, you could say, well, maybe it's something more like, 25%, but with, or 26%, 26% with 7% growth, thereafter or something. The thing is, the terminal stage, again, this is, 10 years into the future, assuming that they would still be growing. You have to go even lower there. And I think this is just, you have to have your head really far in the clouds to think that this is reasonable for a really, really large company to do. What's more realistic? I think you could get behind maybe 8 or 9% for the next 10 years with 5% or so for the following. Upper single digits now, declining into mid single digits. And granted, there's going to be bigger spikes and maybe some years that are stagnant or slightly negative, right? Are they sketchy? Ooh, sorry about the 220, Roberto. That's rough. So, and remember, like, I want a market beating return. So, I'm sitting here saying, I probably want to throw in a 12.5% discount rate. And yeah, okay. Like, and granted, like, I've run these numbers at different times, put in maybe slightly different growth rates and stuff. But when I run PayPal, the numbers I get are kind of all in the same ballpark, even if I run a slightly different number on a different day, or look at different analyst estimates or whatever as my starting point. But I'm never coming up with like $400 one day and then $70 the next or anything like that. My numbers whenever I do like a fresh off the cuff thing for PayPal, they always kind of come in to sort of near where the stock has been recently. But remember, I'm using very conservative assumptions and a high discount rate. So the fact it's still coming in close or even green in some cases tells me it's probably in a zone where you could potentially beat the market with it if they manage to continue some kind of growth. Not 20% or 25% growth, but like upper single digit, slowly tapering down to mid single digit over the next couple decades, right? They were smoking stimulus. Yeah, those stimmy checks would have gotten you like a whole 4 shares or something in PayPal back then, huh? Imagine spending your whole stimmy check on 4 shares of PayPal. So, Peachy, I don't necessarily believe in lost causes. I think unless somebody is like so brainwashed and indoctrinated that they have like an almost religious fervor for a certain kind of mindset, I think most people, there is some type of argument or reasoning that can make them see a different perspective. And it's just, maybe my way of explaining it isn't the right way to get them to see that perspective. But I definitely strongly believe that the reason most people do poorly, like they don't beat the market, right? And they don't beat the professional fund managers who also don't always beat the market. The reason for that is because the average person was more likely to want to buy PayPal when it was when it was a lot closer to that $300 mark than the $60 or $65 mark. And they're much more likely to want to sell it now than sell it back then. And yeah, it's like people tend to always choose the absolute worst times to be wanting to buy something and the worst times to be wanting to sell something when it comes to their investments. Yeah, so Intel is another great example, right? So there was a massive sell-off of Intel when they cut their dividend. Massive. Now, I had, and still do have, 400 shares of Intel. I started acquiring shares somewhere in the low 40s, I think, and averaged down to something like, I think my basis is pretty close to like $34. I'm like this close to even on Intel right now. Never once did I even consider pressing the sell button. Never once. Because here's the thing. I knew after they announced they were cutting their dividend that there was going to be a sell-off of some kind. It wasn't as bad as actually I thought it could be. but I knew there was going to be some kind of a sell-off, and I knew that that was probably going to be, if not the bottom, probably pretty close to it when they did that. Because there were a lot of people just hanging on to Intel for the dividend. And I think being in Intel only for the dividend, or any stock only for the dividend, is kind of a mistake. I think you have to look at the whole picture, and there needs to be more to it than just a dividend. And people who decided to join the little sell-off that happened then, they got out at the exact bottom. All right? It's just human nature. I don't it's like almost sheep-like or lemming-like. And there's reason to believe that people sort of instinctively seek safety in the herd. So like if they see other people are selling, they can't help but want to sell. Oh, Peachy, I have not looked at Zim in a while. How bad is it? Oh. So 2022 EPS is not a reliable thing for Zim. I am curious what analysts think about Zim. I don't remember if I looked at that before. Oh, man. So, what? They think EPS is going to be negative this year? I do not know if I buy this. So, Peachy, do you know if management gave any guidance on their EPS for 2023? It could be. So, they banked a lot of cash, actually. Just out of curiosity. The problem is they paid out a lot of it in dividends, though, so the balance sheet on this data feed isn't probably up to date. $5.8 billion in equity. With $1.54 billion market cap. Yeah, I wonder what their current balance sheet is. Yeah, that's a whole lot of words to not really say anything exactly, Peachy. That probably means they got no idea how it's gonna pan out, and that's fair. I'm actually in an industry that's sort of related. I actually recently did some work on some ports stuff, so I have like a surface level familiarity with this. And investors, financials. No, don't do it. Interim financial statements. Okay. Do. Yeah, $5 billion in equity. So here's what I would do, Peachy. The next quarterly result, which should probably be soon if the last one was and the period ended in March, we should see something probably in the next few weeks. I would be interested in seeing how much tangible book value they have, because I feel like they retained a good amount of cash and such the last time. Like, they paid out a lot in dividends, don't get me wrong, but I think they retained a good amount and solidified their balance sheet. This could be a thing where they've got more assets on the books than what they have in terms of market cap. And yeah, so if you're looking at their balance sheet, the next time they release a quarterly result, and they're showing that they've got tangible book value that's, well, you paid 24. So if I'd say if their tangible book value is 3 billion or higher, you probably didn't get the worst deal in the world. Yeah, I know they are all about efficiency and running a lean operation, and they have some different strategies to where they don't have to spend a lot to maintain. They do a lot of like leasing, from my understanding. Yeah. So, I mean, here's the good news also. They were founded in 1945. So these guys have been around. They've been around the block, okay? They've been around for a while. So, in all likelihood, you have a business that's going to be around for a very long. Ask me after we see some more results. That was the big reason why I didn't jump in around the time you did. They haven't been public long enough for me to really paint much of a picture in my head of what kind of business they are and what they can do. And they went public during a time where there was all this like COVID related stuff inflating the steamship industry, right? The ports were clogged to the brim with no room to offload anything. There were ships doing laps outside off the coast of California. It was crazy. Oh yeah. It's just this. I mean, imagine though if you got them right right when they started trading, and rode this ride and collected all those dividends and such. Would have been crazy. But, that's the thing about hindsight, right? And investing is really more about foresight than it is about hindsight. So, we can look back and say, oh man, what if you did this or what if you did that? Happy 4th, buddy. But it's really, it's a lot harder to, quote unquote, see it coming and make the right decision. And, that's a big reason why I stress the idea of conservative assumptions. I told people on more than one occasion that I start to get interested in Tesla if it hits like $90. And again, that's just where the math of what I think is like a realistically achievable numbers, where it starts to add up to maybe it starts to make sense, right? And that's obviously always I'm always open to having my mind changed or to new information, but I'm not going to sit here and assume that a company is going to grow something by 20-25% a year forever. Speaking of Tesla, so have you guys ever heard of a guy named Meet Kevin? He's the financial guy with. He was started out more doing videos on like real estate and stuff because he was a realtor and owned a few properties. He got into doing stock based videos, during the last probably like, I don't know, 3-4 years, something like that. Basically during the giant run up in stocks, he kind of got big doing stock videos. Tesla was the main one that he was obsessed with. He made assumptions about Tesla. Like he did this whole spreadsheet with his so-called bull thesis on Tesla, where he assumed things that would make Tesla's market cap, like 10 or 20 years in the future, basically the size of the entire current US GDP. And he was saying that they were going to grow like exponentially, be selling more cars than every other automaker currently in the world combined, plus into all these other businesses, and still trading at like 100 PE or something. Like if you actually looked at what was being suggested, it was just absurd on the face of it. And dude, this is the totally messed up thing about it. He has courses that people buy. All right. This is the guy. Does he have any prices? That's the question. Master Stocks and Money. Learn more. Flash sale, only $552 to learn about stocks from the guy that thinks that Tesla is going to be bigger than the entire US GDP in like 20 years. People actually give this guy this amount of money for his course. This is a real thing. He actually makes, like, he's a multi-millionaire. He's worth tens of millions of dollars. Oh, yeah, flash sale. By the way, I've actually I've criticized this before. The flash sale's been going on for months. Like, I think it's always on flash sale. This is one of those things that's on sale, but this is just always the price. Yeah, only $552. Or, being a member to my channel, only $1 a month. I mean, can't beat that. But the fact is, people actually give this guy this amount of money to tell them that Tesla is going to be worth $28 trillion someday. Yeah. And, you know, I have a problem with that. Because it's utter nonsense. Okay? Telling people that. And then, by the way, last year, when things started to look a little shady, he sold all his stocks. He, like, as soon as there was some blood in the water, he panic sold, like, so fast. He was Mr. Tesla Bull right up until he wasn't. I don't even think, honestly, I wonder if he even believes his own, like, I wonder if he gets high on his own supply, so to speak. Yeah, definitely, like, it bothers me to see that, though, because there are people out there that think, oh, if this guy's got he has millions of dollars, right? And so people think, by the merit of the fact the guy has the millions of dollars, that it means if they just pay for his wisdom or secrets or whatever, that good, yeah, don't get to know him, don't give him any clicks, don't give him any more attention. Oh, he tried to run for governor too, and he got a DUI. He's such a clown. Anyway, I'm just saying, right? It's awful that they're, they see this guy, maybe he posts up, like a 7 or 8 figure stock portfolio, money that he got from probably a lot from his YouTube channel itself, because he got kind of big as like a Grant Cardone critic, in which, by the way, do you know what Grant Cardone does? He sells courses just like these ones that are way overpriced and like funnel you in to just spend more money on Grant Cardone courses. So this guy made like kind of a name for himself on YouTube originally by calling out somebody that does the exact goddamn thing he does. Yeah. He did. On May 17th, 2021, and his real name's Kevin Paffrath, announced his candidacy as a Democrat in the 2021 California gubernatorial recall election, blah, blah, blah. Gavin Newsom didn't end up getting recalled, so it didn't end up mattering. Yeah, he thought he was going to pull an Arnold Schwarzenegger on us. Can you imagine? But I hear this guy's like, I mean, I'm not by any means like tall in stature, but I'm also not frail and weak, and I've heard that he's like 5'7" and like 120 pounds or something. And so he's like basically like the inverse Arnold Schwarzenegger. So, and I mean, hey, I'm only 5'7" myself, but I used to bench press 315, so like I'm definitely not 120 pounds. But yeah, this guy, unbelievable. Yeah, get to the. All right. I'll do any Arnold Schwarzenegger quote you guys want from any of his movies. I'll start. Go get to the chopper. All right. I'll be back. Or I'm your twin brother. It's true. I do not lie. Oh, kindergarten cop. Okay. I'm Detective John Kimber. I'm a cop, you idiot. It's not a tumor. Not a tumor at all. We're going to play a fun game. It's called Who is Your Daddy and What Does He Do? No. You tell me. Who is your daddy and what does he do? I'm the party pooper. Yeah, so I'm better at the ones I've practiced before. There are some movies of his where like I've practiced the quotes hundreds of times, and there are others where I haven't so much. Dylan, you son of a bitch. No, I don't think he does. I think being a part of my channel is a way better deal than being a part of Kevin's. Plus, like, I would totally whoop his butt. I told some of you guys watch Ryan's channel too, right? You saw that, like, if you did, you saw a thing where he wants to do like a creator clash thing against Jeremy. Jeremy is another one of these course sellers. He calls his YouTube channel Financial Education. So I told him, like, hey, if you do that, I'll be the undercard against Kevin. I could use the exercise. But yeah, just like the absolute hypocrisy of it. All right, I'm just gonna tell you guys right now. There is no person who's dividend bull. Oh Lord. You know, I don't absolutely. I mean, I've only watched a few dividend bull videos. I don't absolutely hate the idea of focusing on dividends for, if that's what keeps you motivated in investing. So I've always said that first and foremost, the best investing is the type of investing that keeps you consistently putting money to work. If putting money into dividend stocks, I have no idea who Toto Wolff is, but thank you. So, if putting money into a more dividend-focused portfolio and seeing those dividends hitting your account every quarter, month, whatever frequency they hit, keeps you engaged and motivated to keep putting more money into the market, as long as you're not buying stuff that's like regarded dividend traps, essentially. Like, you're not buying like NLY or QYLD or something, then yeah, okay. Like, I think it's fine to have a dividend focus. Plus, if you're also, maybe you want, you're like approaching that final date on which you want to like rely on your investment income to pay your bills or living expenses and all that. Maybe being a little bit more focused on dividends makes some sense. Hey, gotta respect the Austrians. Austria used to be the powerhouse in Europe. Holy Roman Emperor, home of the Habsburg dynasty. Whoa, 18. Did you say 18,000 shares of MPW? I think that's more than my whole portfolio. That's crazy. How much dividend income do you get from that, I wonder? So, it's 29 cents per share per quarter. I at least know that much. So you're making almost 21 grand a year on MPW dividends. Is that correct? Am I reading that correctly? Because that's pretty impressive. Hey, if you picked the bottom on MPW, because of my videos telling you how undervalued it was, and you decided to, take your gain off the table at the, current level, I can't fault you for just locking in a guaranteed win. Bro, forgot to diversify. Honestly, I think he's got other stocks. I don't think he's just MPW all in. Well, I appreciate that. It means a lot to me to know that people who have more capital than myself respect my opinion enough to take it into consideration. You know, I'll tell you, a lot of people will say that that's, too risky or whatever, but Warren Buffett actually has said, like, if you have really strong conviction in a handful of companies, you should take your swings at your most obvious, best opportunities. So, I mean, because all right, here's the it's the concept of unlimited pitches, right? Because there's always another company. There's always another company out there, and so you gotta sit there and wait for the opportunity that you are most convinced is going to get you your return. And so, from that perspective, but the issue comes in when if you're wrong, right? Because if you're only taking 8 or 9 swings and one of them is a big miss, that can hurt, right? But like MPW is one of the ones I am most convinced is correct as far as what I've put my own money into, right? I do put my money where my mouth is. Like, if I'm really, really convinced in it, I'm going to throw capital in, right? So, I think Ares is okay. Like, they're an okay one for me. That's like kind of I view them as sort of a mid-tier thing. But if you're focused on income, it's not bad. I think you'll probably, in the long run, get like 9 or 10% on it. But Arbor Realty, I think I did a video on Arbor, and I think it was mostly positive, but that was a while ago. And that's the problem, right? Even if I look at something and kind of like it, I can't get into everything that I sort of like. I have to be a little bit selective. Truist, huh? Truist Financial Corp? That can't be right. What's the ticker? Maybe I'll find it here. Oh, TFC. Oh, right, I remember, because it's like one letter off from Tattooed Chef. So, Coyote, if you don't mind me asking, what's the makeup of your portfolio, like, roughly? Because you said you have 18,000 shares of MPW. Like, what's like kind of your weighting, your allocation on all those holdings? Because, for example, like, I have Palantir, but it was like less than 0.5% when I first got it. It's grown to be like closer to like 1% or something, because it randomly went up like 131% or something. So Truist. You said this is a screaming deal. Now, is Truist technically a bank, or is it more of like a services type thing? So single digit PE. MPW is 15%. Okay. So, okay. So if MPW is 15%, so you're definitely seven figures. That puts you at what, around 1.5 total portfolio size? Gotcha. So you've that's all right. So to be honest with you, that's a lot of conviction for ARK. Or sorry, I don't want to call it ARK because I don't want people confusing it with that Cathie Wood trash. Ares. Yeah. Okay. I mean, that's pretty solid. I mean, if you've got, so here's the thing I like about that. Now I don't know if you're still working like a 9 to 5 or anything. But if you wanted to not, and you have that much, and you do an income focused portfolio that has some dividends that go up, yeah, you could be, retired right now on a middle class income. I think a lot of people don't realize that you can do that with that size portfolio. Nice. Yeah, I mean, you could already, with a solidly middle class income, you could live off half the income and invest the other half just on that portfolio, depending on what kind of lifestyle you insist on having. You could do it on, like, honestly, and this is something I think people should hear. You could do it for like a quarter that amount if you were willing to do so abroad and live very well. Yeah, most certainly is. And you have, since you still have a regular wage job, right? And you've got now your dividends. Do you have any other businesses other than your job and your portfolio? Do you have any like say real estate or like side businesses, other income streams that aren't either just your regular wage or your investing in stocks? That's really impressive. Personally, long term, I would want to have 3 to 4 different sources of income. I think having a solid portfolio that has dividends, yes, maybe some options income as well. I love selling cash secured puts. Do you do any options? The covered calls aren't usually great on high dividend stocks, but I got most of my MPW shares by selling cash secured puts. And so the premiums somewhat softened the blow of the fact that the price was going down when I was getting the shares. Dude, yeah, dude, you totally should. Get the meet Kevin experience. And then just buy it. Don't even use it. Just buy it as a flex on us peons. Infinite money glitch. Yeah, I mean, yeah, maybe we could co-author a course. It could be $420.69, or we could sell it for $350. Yeah, something like that. $350. Buy it just so that you can leave a negative review. Yeah. So, yeah, I'm definitely. Now, honestly, I'm really looking forward to the next stage of our YouTube portfolio. Like, here's the thing, I never would have bought Nintendo on my own. And thanks to you guys, I now have $500 worth of Nintendo stock. I feel like a true gamer. Remember, it's only 500. I wonder what his other. I wonder if what his other courses. Ooh, the psychology of money. That could be good. Oh my gosh, guys. Don't miss out on 69% off. I see what he did there. Look, he's got a make money and get stuff. His new course features AI, everybody. AI. Dude, AI. Use artificial intelligence to grow your income and save your time. Can you believe, like, this is how you know. It's just, when crypto was popular, he probably came out with one about crypto. Okay? Now that AI is big, he's coming out with one about AI. When Tesla was blowing up, all he would do was talk about Tesla. Oh. It's so obvious, man. It's so obvious. Friggin' featuring AI in his new course. Oh, man. What a friggin'... You want to fuck with me? You're a fucking choir boy compared to me. A choir boy! That's End of Days, by the way. That's Arnold Schwarzenegger also. Literally Arnold Schwarzenegger versus the literal devil. They technically categorize it as a horror movie, but like I kind of view it as like a dark comedy. Oh, sick. Yeah. Yeah, it's on Netflix right now, I think. Yeah, I'm an Arnold fanatic. My best performing video of all time, the thumbnail incorporated the epic handshake between Arnold and Carl Weathers in Predator. Fun fact of the channel, by the way. And it was an MPW video. Yeah. Like, I'm not gonna say it was like, you know, any kind of groundbreaking thing where it deserved an Oscar or anything, but it was a solid movie. People, you know, not everything's gonna be Shakespeare, okay? But it was good. I personally, I've watched it multiple times. I enjoyed it. You know what else of Arnold's is really underrated that's actually pretty solid? Last Action Hero. So, any of you Game of Thrones fans, you know Charles Dance, the guy that played Tywin Lannister. I can show you. This guy is the villain in Last Action Hero. See, it's right here. So, just saying, yeah. It's an extremely self-aware Arnold Schwarzenegger movie. So you know what else is funny? Sylvester Stallone has a cameo in it. So, well, sort of. So they go to the video store. Oh, Sharon Stone. Well, a lot of celebrities did because they were going to like a red carpet thing. Like in real life, Phil. Anyway, what was I saying? So, Sylvester Stallone kind of had this roundabout cameo in it as well because they go into a video store inside the movie that's in the movie. I know, we're getting like Inception levels of things within things here, but they go into this video store that's inside the fictional movie universe that's within the movie, and since Arnold, his character in that movie, is played by Arnold inside the fictional video store inside that movie, they can't have like a promotional display with Arnold because they're in a movie universe where the main character is played by Arnold. So the Terminator, there's like a cardboard cutout of it, and it's Sylvester Stallone in like the Terminator like leather outfit with the shotgun and stuff. Oh yeah. All the women are beautiful, and they all have phone numbers that start with 555. So you're literally like, you know, you already have 3 digits, so you just got to guess the other 4. Oh wait, but that won't work because there's a little something called area codes, as Arnold points out in that movie. So yeah, fun fact. I mean, I'm bullish on Arnold. Oh, so since this is supposed to be financially based, how do you guys know how Arnold actually became wealthy? I'll give you guys a few seconds to answer that question. Don't Google it, by the way. Just take a guess as to how Arnold got wealthy. So Phil's the closest. So Arnold Schwarzenegger was a bodybuilder, and he wanted to get into show business. He got some fame with bodybuilding, but pretty limited. Moved to the US with almost no money in his pocket, and he started a construction-based business. Specifically, it was like bricklaying or something like that. Okay? Have a good one, Coyote. So he started this like bricklaying business, essentially, and he thought, oh well, I'll get business by having the lowest price, and so he put out like ads or whatever in the paper, whatever, advertising his low prices. Nobody called. And back in the day, there was no money in bodybuilding. It's not like today where they can do a lot of like influencer stuff with like Instagram and whatever, and promote products and make a ton of money. That didn't exist in like the 60s and 70s for bodybuilders. Okay, so they had to have real jobs on the side, and he would hire his bodybuilding buddies from like Gold's Gym or whatever to help him out in this business. But like nobody was really calling when they were competing on price, right? Oh, is he an IFBB pro? That's cool, Roberto. Yeah, it is even a grind today. Yeah, not every IFBB pro can make a living off their bodybuilding. Even some of the higher level ones. That's cool. That's cool. So he got this idea, this like kind of stroke of genius to like double his prices and remarket himself as a European bricklayer. He went high end and couldn't stay busy and like couldn't like stop the phone calls from coming in. Basically, they were just booked up solid. And so him and his like, you know, super jacked manly men from Gold's Gym would go do all this bricklaying, and he became a millionaire off of that before he ever got any major movie roles. And I mean, his early movie roles weren't even really that lucrative. Like, I think that technically his first actual feature film was Hercules in New York, and I don't think it made any money. I think his first real commercial success was probably Conan. And even the original Terminator, like I think he did well off of it, but only because of how successful it ended up being. I don't think he got paid a lot up front. The original Terminator was done on a very low budget. They didn't even have proper permits and stuff to film that movie. It was all kind of done like ninja style. They would kind of get in to a place, shoot a scene if any of it was in public, and then get out before somebody could come and ask them if they had a permit, basically. Yeah. So that's just a little fun fact. Arnold was actually a really smart businessman and was wealthy before he ever achieved any success in acting. Bodybuilding had no money, and yeah. And, you know, you look at a guy like that, you think, there's no way this guy made it on his brains, right? That's the assumption that most people make about him, that he's just, you know, a dumb actor, dumb, big, muscly guy, right? That, like, just by looking at him, that's probably what most people would just naturally assume. But no. Truth is, he's probably, like, if he was in this chat room here with us, he'd probably be the smartest guy in the room. So mad respect for Arnold. Anyways, wow, guys, I've been at it for almost 2 hours. I think I'm also going to call it a day and enjoy the rest of the 4th. And I encourage you all to have a wonderful, safe 4th of July. Don't blow off any of your fingers with M80s, please. And, yeah, take it easy, all right?